Yeah, and then if you
Hi, folks. We're going to be getting started in just a minute. I just see people are still joining, so we're just going to give it about a minute or so as people enter into the webinar. Go ahead and get started. If you want to let us know where you're joining us from in the chat, we'd love to see. I'm also dropping, oops, I dropped the wrong thing. I will be dropping the link to the materials in just a second, just in case you want the PowerPoint deck on your own. I see we've got someone from Connecticut and Kentucky, someone from, yeah, it's rainy where we are too. We're in DC and just outside of it. Welcome, everyone. I see someone from New Jersey, Virginia Beach, Seattle, Washington. Also raining in New York. I think the whole East Coast is getting it right now. It's in California. It looks like we've got a steady group of people in. So I'll go ahead and get us started in just a second. All right. Just for some housekeeping items, everyone, come to our GR News Flash on Secure 2.0. My name is Erin Mosier. I'm the Director of Education and Events, and I'll just be your webinar moderator for today. So if you have any questions for our speakers throughout the what we've done is actually enabled upvoting. So if you see a question that you really want to get answered, you can go ahead and hit the thumbs up sign on that question and it'll bump it to the top to make sure that we see it and that it gets asked. If you have any questions about NAEA or any technical questions about Zoom, you can go ahead and drop those in the chat. I'll be monitoring that throughout. Just remember that the chat can be seen by all, so please be respectful to your fellow attendees and use the chat to share information and ideas regarding the presentation material, or as you've already been doing it, letting us know where you are and what the weather's like where you are. So I love seeing that. If you require, close on the bottom of your Zoom screen, and then you can click show subtitle. So each of you have the ability to do that. It's really your personal preference. All right, without further ado, I'm going to introduce NAEA's president, Kathy Brown. Welcome remarks. Kathy, the floor is yours.
Thank you, Erin. Welcome, everybody. It's so good to see everybody here today. I am happy to see at this current time we have nearly 100 participants, so that's awesome. I would like to introduce to you our Director of Government Relations here at NAEA, Michelle McCaughey, and as well as I'd like to introduce Thad, who is our NAEA Legislative Counsel from VP at Vanscoy Associates. I'm going to pass the floor over to them. Thank you both for being here and doing this.
Thank you, Kathy. Michelle, you want to say anything before we get started?
Just hello and welcome, and I will be monitoring your questions.
And Michelle and I were talking before. If you have questions throughout, we're gonna kind of talk about the process of how this bill became law and some of the background, and then we're gonna get into the individual provisions. And so, you know, on the beginning part, but especially when we're in the individual provisions, if you have questions on that provision, just go ahead and ask. We'll also try to leave some time at the end as well, but no reason not to just dive in while we're covering the particular provisions. Yeah, I'm excited for the big turnout. We thought this would probably be useful for folks, but weren't sure how many. So glad a lot of people signed up. And I'll go to the first slide here. Whenever we go live, it always takes a second to go for some reason. There we go. So the Secure Act 2.0 is the large retirement package that passed at the end of the year as part of the Omnibus Appropriations Act. This is a bill that had been in the works for a while, and even before Secure 2.0, we had Secure 1.0, which a lot of you guys probably remember. And Secure 1.0 really started back, I think, in like 2016. It was a very long process, but it kind of came to fruition in 2019. Passed out of the House in July of 2019. There was also a Senate bill that passed out of the committee, but not out of the full Senate. And then, similar to this year, at the end of 2019, it was part of the big Omnibus Appropriations Act at the end of the year. As soon as they passed Secure 1.0, and we'll go into a little bit of the details, just a refresher on that, they started working on 2.0 in the next Congress. And there was a lot of movement in the House in 2021. It really didn't come together in the Senate until more recently in 2022, and a lot of work sort of over the last 6 months, which culminated in kind of a grand compromise between three bills that ended up passing on December 22nd out of the Senate as part of the omnibus, and then out of the House, and then being signed into law. So just kind of wanted to give that overview timeline. And as background on 1.0, as I said, this took a long time to vote. It kind of came to fruition in at the end of 2019. One of the reasons it took so long is because there was the multi-employer pension issues with the big labor unions. And even though this had strong bipartisan support, there was a feeling that they should deal with those issues before they passed this bill. And so that ended up resulting in a several-year delay for the first bill. And some of the provisions that were part of that first bill that they kind of built on as part of Secure 2.0, one was the startup tax credit for new small business plans. We're going to talk more about that. That bill had incentives for auto enrollment. So it had a $500 tax credit if an employer automatically enrolled new employees. It created the pooled employer plans, which we won't talk a lot about today, but some of you might be familiar with. And then it had some regulatory streamlining, trying to simplify some things for employers to make it easier to offer a 401k plan. So that gets us to Secure 2.0 and kind of the process for that becoming law. And the House was really first out of the gate. And a big part of it was the bipartisan relationship between Richard Neal, the chairman of the Ways and Means Committee from Massachusetts at the time, and Kevin Brady, the ranking member from Texas. Kevin Brady's a Republican, Richie Neal's a Democrat, but they had this real shared interest in improving retirement policy in the United States, and worked really well to put this bill together. They were able to pass it out of Ways and Means Committee unanimously. It then went to House Education and Workforce Committee that has some jurisdiction over this issue as well. And they weighed in, sort of adjusted some provisions. And then ultimately they were able to pass it out of the full House in March of 2022. The Senate side had a number of bills in the work, but got a little later start on it. They ended up rolling out in 2022 what they called the EARN Act. The Senate Finance Committee did. It included a lot of the same provisions as the House bill. It had sort of, some unique provisions as well and some differences. And they passed that unanimously out of the Senate Finance Committee in September. And then the Senate Help Committee, which has the P in HELP stands for pensions. They've got some jurisdiction over retirement issues as well. And so Patty Murray and Richard Burr, who headed up the HELP Committee, really wanted to put their stamp on it as well. There were some provisions around emergency savings accounts, additional protections for workers that they felt strongly about, and kind of made the centerpiece of this piece of legislation. But they passed the Rise and Shine Act out of the Help Committee in June. And then starting in around the summer, around August, there was a strong desire on both sides of the, both in the Senate and the House, and Republican and Democrat, to come together, pull these bills together, and have a strong retirement bill by the end of the year. So there was a lot of negotiation that went on between August and December to pull together what ultimately became Secure 2.0. And they were able to attach it to the appropriations bill, which, as we know, passed at the end of December and was signed into law by President Biden. If you look at what made it into the omnibus package, because in NAEA, we were obviously interested in this, but we were interested in what was going to be in that final package from a tax perspective. It was kind of unique. Normally, you wouldn't have a big retirement provision without a tax section in the appropriations bill. But this year, they largely did not have a tax section, and a lot of the provisions we were following, things like the enhanced child tax credit that was being pushed, R&D tax credit extension, where it would be written off in 1 year, bonus depreciation, the 1099K $600 threshold. IRS obviously ended up delaying that a year, but they were looking at a legislative fix for that. These things did not make it in the omnibus package, but the retirement bill did. And so this was kind of the big tax-related provision that made it in the omnibus bill. So what's in it? And that's, kind of what we're gonna be talking about the rest of today is some of the provisions that are in Secure 2.0 that will impact your clients, whether they're small businesses, whether they're individuals, and how you're advising them from a tax perspective. I'll just caveat, and I have this at the end as well, that there are over 100 provisions in this bill. It's a big bill. There's lots of stuff that gets deep into the weeds. We tried to pull out some of the highlights, some of the major provisions that are getting a lot of attention that might come across your desk. But there'll, definitely be stuff that we don't get to cover. There's a ton of information online. Feel free to ask about other provisions as well. But there's a lot of information that's covered in this bill. So from a small business perspective, one of the goals of the bill is to encourage more small businesses to offer retirement plans. If you look at small businesses, the number is actually pretty low. A pretty significant majority of small businesses are not currently offering 401k plans or other kind of retirement plans. And that's because of cost, hassle, fiduciary liability, a number of things. And so Secure 1.0, sought to address that, to really incentivize more small businesses to offer these plans for their employees. And Secure 2.0 tried to step that up and kind of double down on some of those incentives. And so in 1.0, there was a tax credit for small businesses with 100 or fewer employees starting a retirement plan, where they could get 50% of the administrative costs covered over 3 years, capped at $5,000. So if the admin costs for starting a plan, are $5,000 in the first year, you could get $2,500 of that covered. That's been in the law, but Secure Act 2.0 increases that to 100%, which is pretty significant if you think about it. That's effective immediately for 2023. So if the admin startup costs, are $4,000 the first year for a small business to start a plan, if it's fewer than 50 employees, they can get 100% of that covered in a tax credit. If it's between 50 and 100 employees, you still get the 50%, but it's not increased. So the next one, and this one honestly always blew me away, because when you think about a bipartisan tax credit, this is really generous for employers. So Secure 2.0 provides a small business starting a retirement plan for the first time with a tax credit to assist employers in making an employee match. So one of the big hurdles when employers look at starting one of these plans, it's the admin costs and that kind of thing, but it's also, all right, if I want to do a safe harbor plan, which kind of minimizes the risk, as an employer, you have to make that match. And so this provides a tax credit to help employers make a match contribution for those first few years. So the additional credit is for 5 years and up to $1,000 per employee for eligible contributions and plans. The credit applies to employers with up to 50 employees and is phased out for employers with 51 to 100 employees. And so the first year and second year, you can get up to $1,000, a 100% tax credit for your employer, for an employer match, 75% in the third year, 50% in the fourth year, 25% in the fifth year. So if an employer, if you have any clients that are looking to start a plan for the first time, if they have under, if they're a small business and meet the eligibility requirements, they can potentially get all of that money back the first 2 years that they use to make a match.
Hey,
And so
Dad,
that's
we have a question.
okay.
It says, an employer can set up sole 401k after tax year and before filing deadline. Does that include extensions? Does this apply to calendar year 2022 taxpayers? And then could they set up sole 401k in 2023 effective for tax year 22 and elect the regular?
I don't think so. I think this is effective 2023, and I think it's for tax year 2023 because the way it's scored from a fiscal standpoint. And so I haven't looked at that question, but my gut tells me that you can't go back and get the credit for 2022
Because it was effective at the end of 22. Okay.
Yeah.
Does, on what you were just discussing about the matching, does this apply to SEPs and simple plans, SEPS and simple plans?
So let me see the let me get, I do have some material in front of me where I can double check that, but
Okay.
we'll try to answer that by the end, or we can send that out. There's certain provisions that apply to kind of the whole gamut. And then there are other ones that are more focused at 401k, 403b. And so I can't remember if it does cover those.
Okay, well, we can get back to that.
Okay. It might just be, I think it's just 401k and 403b, but we'll double check that.
Okay, well, before you go,
Yep.
one more from Dave Toland. What are the tax implications of these credits? Are they taxable income to the employer? And any idea how the states will address the taxation on the credits?
Yeah, so I'm not sure on the state side. And it might vary state to state. And these are honestly, he probably knows the answer better than I do. I mean, I know it's a I believe a non-refundable tax credit, but how, from a federal perspective, it's just treated as a tax credit. I think on the state side, it would probably depend state to state.
Okay. We also have a participant who has no employees, solo 401k. Can she get the credit for the employer match that she does for herself?
I don't think so.
Okay.
Yeah, I don't think so.
I'll stop bombarding you for now.
No, I'm trying. I printed out the section by section to try to look at some of these, but I don't want to get bogged down in that. So maybe we'll move on to the next slide. But I do think, these are some good questions it raises, and it's I think this is unique. having the startup tax credit for employers offering the plan for the first time was unique in Secure 1.0 because it really covered a lot of those costs of starting a plan. But to me, the fact that they included a credit for making an employer matched was sort of a step further that was a bit surprising that they got the bipartisan support, but it shows the interest in really incentivizing employers to start these 401k plans. All right, expanding auto enrollment. So the Secure 1.0 I mentioned earlier had a $500 tax credit if you auto enrolled your employees. They went a step further in Secure 2.0, and they made it mandatory that you auto enroll your employees. So starting in 2025, for any plan that was new starting this year, so starting the plan would be new January 1, 2023, but this actually doesn't kick in until 2025, if that makes sense. Then employers are required to automatically enroll employees in 401k and 403b plans. Of course, an employee can always opt out, but they have to go in there and physically opt out. If they don't do anything, they're in the plan. And the initial default rate, it's set by the employer, but it's between 3 and 10% with an automatic escalation of 1% per year up until it reaches 10%, but no more than 15%. So it's an automatic opt-in, but then also an automatic escalation. Same with the opt-out. An employee can always go in there and adjust what they're giving. But that's what happens if, if they do nothing, then it automatically increases. And so there is an exception to the requirement for businesses with 10 or fewer employees, new businesses less than 3 years old, churches and governmental plans. The $500 tax credit from Secure 1.0 still applies. So even though businesses are required to do this, they still get the tax credit for it. When you look at retirement savings, the research shows that if you're, a lot of times it's the effort of going and signing up when you start a job or whatever that people don't get around to. So if they're automatically in these plans, savings rates go up, people are just more likely to participate in the plan.
Can I begin with another quick question?
Okay.
This participant has a 401k plan already set up for his business. It's not active and there's been no contributions for over 2 years. He's thinking about canceling the plan. Would starting a new one qualify them for the credit?
That's a good question. I mean, it's supposed to be new plans and, I think the definition of new is up to 3 years old. So if this plan he has is less than 3 years old, he might still qualify as a, quote unquote new plan. If he cancels it and starts a new one, if it was an active 401k plan, then I think he would not qualify. But there might, he'd have to look at the definitions of what is considered, an active plan. I mean, maybe because it's inactive, he could essentially say he didn't have a plan. But generally it needs to be new, meaning less than 3 years old and be the first, first time you're offering it.
Thank you.
All right, next slide. So penalty-free emergency withdrawals. So, one of the reasons people say they don't apply or don't contribute to a 401k plan is they say, well, I don't have enough savings and I can't really, lock all my money up in a 401k because if I have an emergency or something, there's a penalty to take it out, or it's, I can't afford to contribute. And so there's been a push for a long time that there should be either easier access to these to these funds or some sort of account, emergency savings account that allows people to save along with their 401k. Of course, the reverse side, if you make it too easy to get to, then there's what they call leakage, and it's harder for people to save because they're always sort of raiding the piggy bank. And so there was a big effort to try to strike that balance, because you don't want people to use that as an excuse not to save for retirement. And so they did a couple of things. This is the first of a few slides to kind of deal with that. But the finance committee had said, let's keep it simple and let's just allow people to take out a tax-free withdrawal. And so they included rules in the final bill that waives a 10% early withdrawal tax penalty for savers who pull up to $1,000 from a 401k or individual retirement account for a financial hardship. They would also let savers self-certify that they need the funds. So it's not something where they're going to come get you because you didn't really have a hardship. Participants have the option to repay the funds within 3 years. They can't take more emergency withdrawals within the 3 years unless they've already repaid the initial distribution, or they make regular deposits that at least match the withdrawn amount. And this is effective in 2024.
Going back just a moment to
Yep.
the required enrollment starting in 2025, does that apply to existing 403B plans?
Not if they existed before December 31st, 2022.
Okay.
If
thank
you started it yesterday, yes, it does apply. And so that's what I know. The dates were a little confusing there, but that's the distinction. If you were in existence before December 31st, 2022, you're fine. You don't have to worry about anything automatic. If you're new starting January 1, you do have to worry about it, but not until 2025.
Thanks.
So the other penalty-free withdrawals they set up are the first ones for domestic abuse victims. They can take a distribution of up to $10,000 from a qualified retirement plan without being subject to the 10% additional tax for early withdrawals. Similarly, for individuals with a terminal illness are allowed to take a withdrawal out without being subject to the 10% additional tax for early withdrawals. And then also penalty-free retirement plan withdrawals in connection with a qualified disaster. And so allows for penalty-free withdrawals up to $22,000 for qualified disaster recovery distributions.
Have they said what constitutes emergency, or do we need to wait for IRS regs?
Are you saying a qualified disaster?
Yeah, for
Yeah. So normally that's like a FEMA, when there's a hurricane, there'll be a presidential declaration for a disaster, which kicks in your ability to get FEMA relief, SBA relief. And so it's under I think it's the Stafford Act. It would be under that. So if you had if you are hit by a hurricane and the president declares your state a disaster, a qualified disaster zone, then you could qualify for that.
Oh, how does one prove domestic abuse?
That's a good question. I think there are details. I forget if it's if it's a doctor or maybe not a doctor. There's some sort of certification process, and I can look. I can go back and look at the details, but I'm not exactly sure.
Okay, let me ask one more.
Okay.
For a business that has 11 employees in 2026, the minimum rate is 4%. Is this employer contributions?
Say it again.
It says for a business with 11 employees in 2026, the minimum rate is 4%. Is this employer contributions?
Are they saying for the if they're discussing so this is not employer contributions. This is saying this is for employee contributions, and it's sort of the default rate that's set. So you have a new employee, they start, let's say in 2025, you automatically enroll them and you put them, let's say the employer says, we're going to start everybody at 3%. That's the minimum that they started by. And this employee doesn't do anything. They don't go in to change it. They don't make any changes. They just don't do anything. Then in 2026, their contribution, the employee contribution automatically gets escalated to 4%. In 2027, it automatically gets escalated, to 5%. And so that's just the default rate that the employee's going to pay into the plan. Has nothing to do with the match. And just to stress, the employee can always go in and change and say, I don't want to give anything, or I only want to give 1%. But this is that default rate for people that do nothing, sort of what gets taken out.
Okay, let's see. One more regarding the $1,000 withdrawal for emergencies.
Yep.
Has emergency been defined, or we need to wait, or is it self-determined?
No, it's self-served. So they tried to make this really easy. And so I do think there's some definition, but it's self-certify. And so I think it's pretty subjective. If you feel like you have a financial hardship, you can self-certify and go take that $1,000. They're not gonna come after you. They tried to make that very easy.
Okay, great, thanks.
So the last thing they did, and this came out of the help committee in the Senate, had really wanted to do something around an emergency savings account. And so they ended up just putting all of these in the bill as, this one being an option. So beginning in 2024, retirement plans may offer linked emergency savings accounts that permit non-highly compensated employees to make Roth contributions to a savings account within the retirement plan. Balances in an emergency savings account must be eligible for distribution at least once per month. Employers may automatically opt employees into these accounts at no more than 3% of their salary, and the portion of an account attributable to the employee's contribution is capped at $2,500. So the first thing I'll say is this is optional for an employer. They don't have to offer these, savings accounts, but if they wanted to, they can set up a savings account that sits alongside the 401k. So it's actually a separate account, and it's a Roth account, so you can't do pre-tax into that. And it's, emergency savings account. So you can do a employee, payroll contribution into that. There's a match option, I believe, where an employer could match that. And then it allows for a savings, a savings account. Some people don't like this because, and the reason they did these allowing you to take $1,000 withdrawal and stuff, it can get a little clunky from an admin standpoint. Let's say you have a pre-tax 401k account, and then you have one of these Roth savings accounts. You're putting some contributions in the 401k account pre-tax, you're putting some in the savings account after tax. And that's why they made this voluntary, and they said you could also just take it out of your 401k if you needed the money. Any questions on that?
Nope.
All right. A starter 401k plan for employers. So we talked about the goal being, how do you get more employers? Majority of small businesses not offering plans currently. How do you get more of them to offer plans? One was to say, all right, if you offer a 401k or 403b plan, we'll give you this tax credit for the admin startup costs. The second one is permitting an employer that does not sponsor a retirement plan to offer a starter 401k plan. It's attractive because it streamlines regulations and has lower costs. Employers are not required to provide matching contributions, but it still creates a safe harbor for the non-discrimination and top-heavy testing requirements for defined contributions. So currently, that's the issue with 401ks that a lot of employers have to do. They either have to pay the match, or they're subject to potential penalties at the end of the year if their plan ends up being top heavy. So this alleviates that, but the limit on annual deferrals is $6,000 a year with an additional $1,000 for catch up. So it's the same as the IRA. So these are not 401k level contribution levels. This is the much smaller IRA level. These are effective in 2024. Automatic enrollment is required if an employer offers it. But of course the employee could always opt out. So it's another tool that folks can use, small businesses can use if they're trying to start a plan, but low risk, low cost to the employer. It kind of reminds me of like the MyIRA. I don't know if folks remember MyIRA, which were these payroll accounts that Treasury came out with under Obama. It was the IRA limits. They just tried to make it simpler. Those never really took off, but I think these have some attractive components that folks might like. Student loan payments and employer 401k matching contributions. So another reason, a lot of young people don't join their 401k is they say, well, I've got all this student loan debt. I really am worried about that. I want to focus that off before I start saving for my retirement. And there has not been a tax advantaged way for employers to contribute to a 401k if the student is focused on their student loans. So this allows 401k matches on student loan payments. So if you're a student, or not a student, if you're an employee and you're making a $500 payment to your student loan every month and you're not contributing anything to the 401k, the employer can match that $500 payment you're making to your student loan with a payment to your 401k. So what they otherwise would have been contributing to your 401k if you'd been giving to that 401k, they can make that as a tax advantage match. There were a few large businesses that were doing this before, but they were not doing it in a tax advantaged way. They had gotten permission, through IRS and Treasury to contribute, but they were having to pay taxes on that. So this allows it, the same treatment as if you were making that contribution to a 401k if the employee was. So it says permits an employer to make matching contributions under a 401k plan, 403b plan, or simple IRA with respect to qualified student loan payments. And that's effective next year in 2024. And most folks were for that because it just gets more people in the game. And student loans is obviously a big issue. And so it provides a little more flexibility around that. Any questions on that issue?
Not so far. We're good.
All right. Savers match. So I'm sure a lot of folks are familiar with the current Savers credit. So the current Savers credit program allows those meeting lower income thresholds to claim a tax credit for contributions made to a workplace savings plan or IRA. There's two kind of complaints about the current Savers credit. One is a lot of people don't know about it. I think something like 55% of the people that qualify for it never heard of it, don't know it's available. And this bill does sort of put something in there that for the next few years, while it's still around, Treasury should do a better job advertising it. The second piece is it's a non-refundable tax credit. And this is for lower income individuals. So a lot of them are not paying any taxes. And so obviously if it's non-refundable, if you're not paying any taxes, it's not gonna help you. And so they tried to sort of rework this to make it helpful for those that the credit's intended for. So effective in 2027, the credit is being replaced by a Savers match. And the match will equal up to 50% of the first $2,000 contributed by an individual to a retirement account each year. So you can get up to $1,000 match or credit. And the credit will phase out for taxpayers with modified adjusted gross income above $41,000 for married taxpayers filing jointly, $30,750 for taxpayers filing as head of household, and $20,500 for single taxpayers. So this is obviously targeted at lower income thresholds and is intended to provide that extra incentive to contribute to a plan.
Now we have another question going back to the student loan issue.
Okay.
Is it dollar for dollar when paying off the student loan and contributing to the 401k, or is it 3% match of the amount paid to the student loan?
It's whatever the business is doing for, you know, the business can make a decision sort of like they do for a 401k match. So if you work for a company that matches dollar for dollar for the first 5%, then, you know, maybe it'll be that, well, a dollar for dollar for the first 5%. If a business wants to do 50%, so, you know, a lot of businesses for every dollar, they'll match 50%, you know, 50 cents. Then you could do that for the student loan. The same sort of requirements that exist for a normal 401k match would, my understanding is that, you know, they would apply here. And so if a business is doing, you know, a dollar for dollar match up to 5% of your income, then if you were contributing 5% of your income to your student loan, they could do that 5% match into your account.
We have two questions on the savers match.
Okay.
One, do you have any idea why the savers match doesn't start for 4 years?
It's a good question. I don't really. You know, some of these things they put out a few years for, they wanted this bill to be revenue neutral. And so they had to play with the dates a little bit. Some of it's gamesmanship because there's the 10-year budget window. And so they played with dates a little bit to make the bill come in not costing too much. So that might be part of it. But then there also might have been some thinking about phasing out the savers credit, you know, required more time for whatever reason. So those are just my guesses.
Is the savers match paid by government?
Yes. Yes.
Okay, and then one more on that. If the savers credit now goes to the retirement plan, will it be a deduction if it goes to a traditional non-Roth account?
I'll have to think about that. I don't think so. I mean, the match will equal 50% individual to a retirement account each year. Yeah, I'll defer on that one, but I just thinking about it, I don't think it's a deduction.
Will it count toward contributions in the year contributed to that year's savers match?
Good question, and not to, like, you know, speculate here, but I don't think anybody that's making, you know, $20,500 as a single taxpayer is probably maxing out their 401k. Now, if it's an IRA, it's 6,000, so maybe so. I don't think it goes towards the cap because caps are normally, you know, based on personal contributions, not matches, or, you know, whether it's an employer match or whatever. So I don't think it goes towards the cap.
Okay, can we flash back to disasters and emergencies for a minute?
Sure.
Assuming there is a disaster with the governor declaring an emergency, is that sufficient to trigger the benefit?
So it's qualified disaster recovery distributions. I'd have to go back. And let me just look real quick if they have a definition here. I'd have to go back and look at the exact definition they use. Whether, normally the way it works under the Stafford Act is the governor requests through the Stafford Act that the president declare a declaration in order. So the governor has to gather a certain threshold of information, and then they put that request into the federal government. And then the federal government makes a decision based on the criteria. And then that triggers FEMA support, SBA support, all of that. Now, there might be within certain states, certain disasters that can be called that are not at the federal level, where just the governor says it's a state disaster and it doesn't trigger any federal assistance. Whether those are covered under the definition, I'm not sure. We'd have to look at the definition they use for qualified disaster. But I have a feeling it's probably under the Stafford Act, federal disaster.
Okay. This one is back to the savers credit. She's looking for clarification on that she understands correctly.
Okay.
It says, so savers credit paid to account is worse than paid to client. Because client could have used credit to contribute to next year's IRA and might even get deduction if it's traditional.
Yeah, so the goal here was to make it more attractive, make it more targeted, and make people know about it, make people more aware of it. And so I don't know if that was more of a question or a statement she had, but
We can get back to her later. Thanks.
all right, we good on questions or?
Yep.
All right, this one should be pretty straightforward. Increase in age for required beginning date for mandatory distributions. So Secure Act 1.0, which passed in 2019, increased the required minimum distribution age to 72. So folks are familiar with that recently going up. Secure 2.0 further increases the required minimum distribution age to 73 starting January 1. And then it increases the age to 75, not starting until 2033. So we've got 10 more years before it hits the 75. This is repeating myself, but I have, in other words, individuals who turn 73 this year must take their first distribution no later than April 1st, 2024. The distribution for subsequent years would need to be made by December 31st of that year. Note that people who delay their first withdrawal until early 2024 would need to take 2 disbursements next year, one for 2023 and one for 2024. So there's a bit of a transition period there where they let people, take these. But yeah, they're moving up that required minimum distribution age. Obviously, people are working later and, living longer. And so they might want to wait before they're required to take that money out of their plan. And this allows them to, delay that a few more years. So higher catch up for older individuals. In 2023, participants age 50 and older can contribute an extra $7,500 per year annually into their 401k account. This amount will increase to $10,000 per year, indexed for inflation, starting in 2025 for participants age 60 to 63. Also, after 2023, all catch-up contributions for participants earning over $145,000 annually must be made on a Roth after-tax basis. And I can give you the background on that a little bit. So when they were drafting this bill, they were trying to figure out how to pay for it. And one of the major pay fors was, let's make all catch-up contributions be Roth, where you have to make them after tax, because at least in the short term, that first 10-year budget window, that will help pay for a lot of this stuff. There was some pushback because the thinking was, well, isn't this the time where you need the most flexibility and trying to figure, these are people that are on the verge of needing to retire in the next, decade or two. And is this a decision they should be making with their financial advisor? So after running the numbers, does it make more sense to do a pre-tax catch-up contribution or a Roth contribution? Should we really take away that flexibility to choose? And so there was some pushback on the bill. And so they came out with this compromise and said, all right, if you make under $145,000 a year, we'll still let you do a pre-tax contribution, catch-up contribution, if you think that's, what works best for your finances. But if you make over $145,000, we're going to make you do a Roth, because we need to, pay for this bill. And they felt like that was a high enough income level where the flexibility wasn't as needed. Any questions on that?
No, there's one back on the student loan issue, but
Okay.
why don't we try to catch, you've still got about 8 slides to go, so I don't want to interrupt your.
No, we're good. I think we're okay.
Okay, it's a 2-part question. Is the student loan match only for starter 401k plans for employers?
It's for everybody.
Okay, so he's saying, so not for existing 401k plans, right?
It is. So if you're in AEA and you guys offer a retirement plan and you've got folks contributing to a student loan and not to the 401k, but they want to get a match into the 401k plan, you can start this. I think it was 2024, but you can start this up. It's not just for new plans.
So say your company has 3% match, can the employees split it to contribute to the plan and to the student loans?
No,
Okay.
so the payment to the student loan has to come from the employee's money. I mean, so you go, if I pay $500 to my student loan, and then my employer can match that $500 to the 401k plan. It's not about them paying your student loan. There are some businesses that will pay student loans. It's not tax advantaged, but that's separate from this.
Okay, so can they allocate the 3% to the student loans and still contribute non-matched amounts to the plan?
Yeah, no, so same kind of misunderstanding there. The employer money will only go to the 401k plan.
Okay,
It doesn't go to the student loan. It's the employee's money goes to the student loan. The employer money then goes to the as the match to the 401k plan.
okay, so now, and then another question, is there a marriage penalty?
For
I don't know if this is for the
trying to think which one that would be for the Roth, maybe for the that might be for the Roth contributions.
yeah.
Yeah, I don't think so. I think it's just I'm not sure how that's handled. I think it's just if the individual, whose 401k plan it is earning over 145.
Okay. Okie doke.
All right. Yeah, I thought we had all this time, but it is I see it's 52 after.
Let me just throw this in. Can the employer withhold the student loan, student loan, FBO student, and then pay for the student? Is that allowed?
No, so it's pretty simple in that the student has to give has to pay their student loan, And then the employer can match that amount, either dollar for dollar or 50 cents on the dollar to the 401k plan.
Right. Got it.
And there are other things, there are other provisions out there, like in the tax code. For instance, an employer is allowed to spend up to $5,500 on tuition for an employee, tax-free. So some, companies say, oh, if you want to go back to school or whatever, we'll pay,
Right.
up to $5,500 a year tax-free. So there are other provisions, but this one is just strictly about matching a 401k plan, what you've paid to a student loan.
Okay, I think we can move to your next slide.
Okay. This one's kind of interesting, I thought, as someone with 3 little kids that I'm trying to give to a 529, and I will probably never have money left over in my 529. But if I do one day, which is highly unlikely, maybe if they all get scholarships to college, then you can roll over the 529 plan for the beneficiary. So whoever the beneficiary of the 529 plan, without tax or penalty, into a Roth IRA. So the 529 account must have been in existence for more than 15 years at the time of the rollover. Aggregate rollovers cannot exceed $35,000. So you have people that are scared that they're going to contribute too much to their 529. Let's say they're contributing enough for their kid to go to a private university, and then they decide to go to a public university, and they graduate, don't want to go to grad school, and there's $35,000 left over, and they don't have, another child they can transfer it to. Then you could roll that over tax-free into an IRA for the benefit of the beneficiary of the child. So that's new. You don't have to take a penalty, to take it out or pay taxes. Credit for military spouses. So trying to get the bar to move so I can read this, but there's an issue with military spouses where they move around. Military families move around a lot, and so they end up not vesting or becoming eligible for retirement plans, because a lot of companies say you have to work here for a year before you can join the plan, and then you have to be in it, X amount of time before you can vest for the match, that kind of thing. And so this creates a small tax incentive for employers if they allow military spouses into the plan immediately and allow them to vest immediately. That way they can start, earning the money and then, or saving the money. And then if they have to move or something, they won't have missed out on it. And so that's, the basics.
Got a couple of rollover 529 questions.
Okay.
When does the 529 rollover start? What year?
I can check that.
And then,
I'll have to check that.
okay, and then this is the same question from a second person. When does the provision start? But she says there's one client with way too much in their 529s.
Okay, yeah, I might be able to just check that real quick. But is there another one, or should we?
No, there were two, both had the same question.
Okay.
About when it starts, and then the second question was what year?
Yeah, I tried for most of these to do. Okay, so it starts immediately. Beginning after December 31st. No. That might be a different provision. I'll look at that. Just give me a second. I don't want to delay the.
Okay.
All right. So Roth treatment. There were a number of things. I know we talked about the catch-up contributions. There were some changes around simple and plans and SEP plans around Roth. So now simple IRAs and SEPs can allow employees to treat contributions as non-deductible Roth contributions. Catch-up contributions, we already covered that. And then Roth treatment of matching or non-elective contributions. So under 401ks, 403bs, plans can allow a participant to designate some or all matching contributions and non-elective contributions as designated Roth contributions. So currently in a 401k plan, this is my understanding, you had to, if I decided to contribute to my Roth, to my 401k after tax, then the match still had to come in pre-tax. So you end up sort of with two accounts. You have your Roth account that you're given to after tax, and then the match was pre-tax. I think what this does is allows the employer contribution to be Roth as well.
Is it true that these rollovers can't be more than the contribution limit of a Roth per year?
Are you going, is this the 529?
It doesn't say.
I know the 529, it was that, I think it was 35,000 was the cap.
35. Also, in that response about the start year, Mr. Google seems to say that it's 2024.
2024. Okay. Yeah, that's what I was trying to do too. So that sounds right. 2024, but we'll make sure to confirm that as well. All right.
Let's see here. Can a self-employed person contribute to SEP amounts to Roth?
I think that's what that first provision was saying you can now do SEPs, you can now treat contributions as Roth contributions.
And that's okay for a self-employed person?
I don't want to give tax advice. I don't, if you have a SEP, they're saying you can do it, but I don't know the details of that.
Okay, fair enough. Thank you.
As I say, the guys, the folks on the call know a lot more about it than I do in terms of how this probably, how tax credits are handled and how, you know, and so.
Is there a maximum amount that one can pay on student loans through a 401k?
So it's under the standard match sort of guidelines now, you know, so I think that, you know, currently you can give, I don't even know what the limit is now to a 401k, but it's, let's say it's 24,000 a year. I'm sure someone will put it in the chat box, but it's $25,000 a year you can contribute to your 401k. And then whatever the employer wants to do in terms of a match to that, you know, most employers will only match up to, I've heard of 8%. I've never heard of, you know, 100%. Maybe
Yeah.
Some companies do 100%, but I think they can, whatever they're allowed to do for a match, and maybe it's up to the 24,000 they're allowed to do for the student loan. Because it's essentially treating that as, you know, as a contribution to your 401k for purposes of calculating what the match could be. And saying it's still tax, you know, tax advantaged. All right, I know we're a couple minutes over, so I'm going to be quick. This is an interesting provision where it allows the surviving spouse to elect to be treated as if the surviving spouse were the employee for the purposes of the required minimum distribution rules. So for example, if the employee died before he or she is required to take his or first required minimum distribution, this allows the surviving spouse to stretch out the RMDs over the surviving spouse's lifetime and defer RMDs until the surviving spouse is required to take his or her first RMD. So this was not an option prior to Secure 2.0. And so they either had to go ahead and take the distribution, or they had to roll it over to their personal, you know, IRA. So if you're 80 years old and your spouse is 60 years old and your spouse, passes away, for purposes of required minimum distribution, you can use that age of 60. You don't have to use your age of 80. This is one that you had flagged for me, Michelle, which has kind of been a controversial issue, and it's basically conservation easement deductions for pass-through entities. And so my understanding, and I'm sure folks on the call are more familiar, but if you have a big piece of property, folks would give up their development rights or certain other rights, easement rights on the property. In exchange, they would take a big deduction and, save tons of money on their taxes. And so this limits that, basically still allows it to a degree, but tries to break, they were saying it was being used in a fraudulent way where people were taking these massive deductions and paying no taxes. And so it seeks to crack down on that. So here's the summary. I mean, basically, obviously, lots of highlights we covered today. There are a lot more we did not cover. There's over 100 sections in this bill. I think we hit, a lot of the main ones, but obviously there's a lot of stuff we did not cover. As you saw, it impacts small businesses, it impacts individuals, impacts anyone offering a retirement plan. And, the goal today was kind of like make folks aware of these provisions if they weren't aware and kind of put them on your radar. We obviously didn't have all the answers to sort of some of the nuances of how they're applied or what the definitions are. But there is lots of information online or other resources. A lot of the major law firms put out sort of, write-ups on sort of how these are applied. And so, we're happy to try to answer questions, but mainly just wanted to make you aware of these provisions. So if you do have an issue, to go sort of dig a little deeper.
We had some kudos in the chat about this presentation providing more detail than some of the other previous presentations these attendees had participated in. So
oh, good. Yeah, well, it's hard to cover a lot of ground and be detailed at the same time. So hopefully we struck a balance where we answered some of your questions, but also covered a lot of ground. But I think it's an exciting topic. I think it's lots of opportunity for probably all of your clients to, potentially get some advantage out of this bill. Obviously, there's, if they're a small business, there are opportunities. If they're retiring soon, there are opportunities. If they've got 529 plans, God bless them that they've overfunded, then there are opportunities. So anyway, I'm glad it was helpful.
Well, I'll wrap us up since we are just a few minutes over time. I would like to thank everyone for your participation. We had really great questions and thank our two presenters. Just a reminder that this recording will be posted on NAEA's YouTube in the next few days. So if you need to rewatch it or want to send it to someone, please feel free to do so. We do these hot topic GR webinars every quarter. This is actually just a news flash. So we're going to have another GR webinar next month as well. So we hope to see you at that one. And we're actually doing a deep dive on Secure 2.0 at our in-person event in Scottsdale this summer. So if you really want some more additional information about how to do the taxes of all of these different implications, make sure to check that event out once registration goes live. So this concludes today's program, everyone. Thank you all, and we look forward to seeing you at the next one.